All right, welcome back to the channel once again. What I want to do here for you today is to show you what a worse type of trading model is going to look like. So what I've done here, you can see this is a universe, many worlds. I believe this is 1,440 different combinations of the parameters that I'm going to set out for you in a minute. 1,440 different worlds. Ranging from a plus 65% to a plus, this is log, plus 126% log. And this is over, again, the same 23 years. I kind of have it differently here on the x-axis. 23 years of the S&P. Remember, the S&P is 1.57. So every single one of these models vastly underperformed. My model, the one I use, because it's nothing like this either, is 1.44. on the longs and another 0.45 to 0.5 on the shorts. So we beat the market with a much better risk reward. And this thing, or all of these, don't even come close. But what I want to show you here, this is a moving average cross plus a couple of other parameters that make it a little better. Right? So this is a lagging indicator. So what you're going to see here, what I'm going to show you, is the type of thing you're going to run into when you're doing moving average crossovers. Stochastic is going to be the same thing. RSI is going to be the same way. These are all lagging indicators. It's not that lagging is bad. It's just that these ones, the three I told you, and anything that smells like that, are especially bad. You have to definitely try to build a better mousetrap than most people are going to when they do stuff like this, when they use these lagging indicators, and or else you're just going to horribly underperform. Now, this wasn't intentional, but it is an example of what I talk about, why you have to do the many worlds, the many universe type of testing on this, because what I'm going to show you here is all too often what people get into. So first of all, I'm going to show you, this would be the best, no, the worst, about that 0.65, that's this one. And this one's the best. I'll just tuck it over here, 1.26, right up here. So what parameters do we have? Well, it's something you guys are going to be very used to. A short moving average and a long moving average. Now, you're going to have some sort of take profit. And most people will do a take profit when a short passes underneath the long of the moving average. That's an utter disaster. So you need to have another idea. You can use that as one of the checks, but you're going to have to double up on some of the checks or you'll be stopping out all the freaking time. And I'm going to show you an example of that in a second. So the other two parameters you see here, stop loss is 3% from a high, and it's called profit target, but really how much of a move up are you going to have before you put any type of stop loss in at break even? So in this case, you need a 10% move up before we put our stop loss at break even, which also allows you to lose 10% from your entry point. So what I've given you here, again, what is the universe of different worlds? Just actually, let me pull this up. I got to move this over here for a second. Give me a sec. I need to pull up all the parameters. Give me one sec. So on the moving average parameters, we went from, on the short, from 20 to 50 day moving average in 10-step increments. The long moving average, 60 to 200 with a 10-step increment. Now the stop loss from once you reach a high, between 2% and 5%, kind of like a stop loss, draw down from a high once you're in a trade, in 1% increments. And that profit, so how long are you going to let this thing run with profit before you move your stop to break even? And I'll tell you why that matters. I'll show you why that matters in a second. That is from 5 to 10% with 1% increments. So that's where you get this 1,440 different worlds from. Every combination thereof gives you this. So yes, I had previously to what you're looking at here, I had actually spread those parameters out a little more, and I had over 5,500 universes. And again, like I'd mentioned, I've got a pretty powerful computer and it did a stutter. It definitely took a while. Even this 1440 takes a while. So you trying to do something like this, getting back to what programming language to use, try to do something like this in Visual Basic, your programs are probably going to crash or take forever. Like, do it now before you go to bed, and when you wake up in the morning, maybe it'll be done if it hasn't crashed. You're going to run into those problems as well. So you can see that this moving average, stochastic, RSI type of lagging indicator where you get crossovers of any type, they tend to do poorly, but they're easy to understand, so most people use them. So one thing I want to show you here is why you need to do stuff like this. What if you data snoop the ass off this thing? You see this line up here? Okay, that was this guy here at this X66 plus 16% log. Okay, it stayed out. This was the 2008 crash. Because of the way it's programmed, it stayed out a long time. And it did end up being the winner. Now, if you data snooped too much and you got this one, just say you data snooped and you found the highest one at the end and you said, okay, I'm going to choose that one. That is a big mistake, because the next step is finding the size you're going to take. Now, look at this. One of these 1,440 paths did this. Every single one. You change any of these parameters, any of these, just a touch, you are now gone from plus 23% to minus 23 maybe, so a 46% swing. And if you've sized for this and you got this, any one of these, you just blew yourself out. This is why I say you have to do the many worlds, the many universes. You have to see, are you standing on the edge of a precipice that if you fall off, if things don't go perfectly right, the future versus your history, and you know that's going to be the case, you won't even know. Most people won't even know they're headed for a disaster. Man, it worked perfect when I was back testing it. Yeah. Well, what you didn't do is do this and recognize, yeah, this was one lucky set of parameters. You moved that one touch and they were all down here. This is why you have to do it. And this one right here, 16%, ended up being this one only because of this one lucky parameter. Every single parameter, every other one was just lost. Now, didn't lose probably as much as the market because it stopped out through a lot of it, but every single one lost way more than this one. And this 14%, which you couldn't have discerned, these two back then, ended up being the worst. So this is why you need to do this stuff, and this is a great example. I was very happy when I saw this. This is quite an extreme situation, but it's exactly what you're going to fall into if you don't do this stuff. So let me show you why moving averages and stochastic and RSI crossovers by themselves don't work. So this is, I don't know, one of these trades, but it's indicative of what I'm talking about here. Stopped out for whatever reason. I do know the reason. Got back in. All right. All of this up and down, the short crossing over the long, back and forth, finally stopped out here, actually when it was smooth, but we didn't get shaken out. You would have been stopped out, back in, stopped out, back in, stopped out, back in. This ignored it. And look at this one. I know why it didn't stop out here. Had it gotten much worse, it probably would have. But look at all the crosses you're going to get. The outs and ins, outs and ins, outs and ins, outs and ins. And as we started to roll over, yeah, it did stop out. But then it did get kind of what we now could understand as a false signal, but it stopped out very quick. So you minimized your trading and chopping, which means a lot as well. So you have to check the data and you have to plot this stuff so you can kind of see, okay, what was the path this took? Would it have me just being chopped around and stopped out as the moving averages crossed over, which is what you're going to get on all this style of lagging indicators. And you're going to have to get back in, and people are unwilling to get back in after they've just been stopped out. And you can see it's almost always the thing to do. So this was a rather smart version of these moving average crossovers because of what I added into it. And I add stuff in because I know the statistics of the market and I understand what these types of indicators do and why most people that use them end up throwing them away because they're garbage. You need more than just that. So this was an example of how simply using crossovers is dog shit. You need to use more. And I don't remember which one this is. It was either the good one or the bad one. I can tell you the better one here had less trades than the worst one, and it makes perfect sense. Why? You should know these numbers by now because I cite them all the time because they are the cornerstone, or at least one of the corners, of building a better mousetrap. And it's history has shown that you need to be long the S&P roughly 92% of the time. So the less trading you do and the more time you're in the market, the better off you're going to be versus trying to trade and be out of the market for far too long, or worse yet, be a two-tick nick and short the market, which, yeah, that's the exact opposite of what you want to do. Okay, there's no money to be found there. And as you can see, as I've shown, the actual market itself was way up here. Actually, it's off the chart. That's how even ones that I'm trying to make smarter in a simple format, just simply, again, using a couple things that would force it to stay in longer than just crossovers. Fair. They still massively, massively underperform. So let's take a look at these and I'll wrap up here. What was the best one? Let's look at the characteristics of the best ones. Well, the profit target, okay, letting it run before you move to break even. Better ones, 10%. The worst ones, 5%. As a reminder, the range only went from 5 to 10%. So waiting before you moved your price to break even stopped a lot of this chopping. Right? Now I know that. That's why I put this parameter in there. Now you know that too. Or again, come on down, patreon.com/P.O.S quantitative. I make better models than this all day long. I would never show you one of my models because it's proprietary. But what I can do is show you what you need to do if you want to develop your own models. And I know people are going to be using these types of models. And they're dog shit, but I will show you why. And I will show you ways of maybe making them better, but they're still worse than the market in general. Now, I say that as far as overall raw return, yes, but the drawdowns on some of these, which I haven't done and haven't shown, are likely going to be better. So it may very well be with a lower drawdown, you can leverage it and you can push your return up past the equity markets. There's a nugget of gold for you. Play that a couple times and use that as some sort of ruler if you want to build your own. That will take you a long ways. Just throwing out gold here everywhere for you. But anyway, patreon.com/P.O.S quantitative. The link will be down in the description. And if this has helped anyone, great. That's partly what we're here for. All right, I'll be back probably at some point, hopefully in the near future, to show you more worse-er ones. See you then.